One, two, three, start.
Hi everyone, my name is Gloria Raju and I'm here to speak on certainty equivalent approach, a method of analyzing risk for capital budgeting. Now, even before I get into what certainty equivalent approach is, capital budgeting, it is very essential to analyze the risk that arises on the account of uncertainty of the future cash flows. Now, therefore, it is in any condition in which there is a possibility of deviation from the desired outcome, and this is known as risk. Therefore, it is very essential for investors to analyze what all risks are happening in the firm and outside the firm before they put in their whole money to a particular investment. Now, the financiers of the various country and all around the world, they have come across various methods of analyzing these risks. And some of these methods are the risk-adjusted discount rate, the certainty equivalent approach, the sensitivity analysis, the standard deviation method, the coefficient of variation, and the decision tree approach. And I would be basically focusing on the certainty equivalent approach. Now, in the certainty equivalent approach, what happens is the cash flow are divided into certain cash flows and uncertain cash flows. Now, in which the expected cash flows, they are adjusted to reflect the project risk. Now, the risky cash flows are scaled down because the riskier the flows, the longer their certainty of the equivalent values. Now, then the uncertain cash flows, they are converted into certain cash flows by multiplying the cash flows of the probability of occurrence of such cash flows. It means that when you're dividing the cash flows into certain cash flows and uncertain cash flows, you are sure that a percentage of the cash flows you would get back. Okay, now for example, if ever you're going to invest 10,000 rupees, out of this 10,000 rupees, you are sure that about 0.8. So the certainty coefficient is always a value between 0 and 1. So you're sure that a certain percentage of this 10,000 you are going to get back in your future date. In such scenarios, what happened is you will multiply the value of the cash flows into the coefficient value of probability, and then you'll get rupees 8,000 where you're certain to get back as cash flows. Now, after the cash flow has been multiplied, what happens is either the internal rate of return, which is IRR, or the net present value, that is NPV, can be taken as a value of measurement to evaluate the return on investment or the capital budgeting. Now, the method of certainty equivalent approach, it directly flows from the utility theory. Utility theory is mainly taken from economics, which means that the investors or the consumers, how much are they willing to risk in a particular utility that they need to invest in. Now, the decision maker must first evaluate a cash flows risk and then specify how much of money is to be received with certainty, and will make him or her indifferent between the riskless and the risky cash flows. So they need to first understand what is the risk of the particular cash flow, and depending on that, he needs to specify on the amount of money that he is willing to invest in a certain investment. Now, after the cash flow amount has been multiplied, you need to definitely remember and keep in mind that you would be either using an NPV or an IRR to evaluate the capital budgetary. Now, for your information, I've also given in the presentation the equation for this, that is the certainty coefficient is equal to the expected cash flows, which is the certain cash flows, and divided by the risky cash flows. Now, let me explain this whole theory with an example or an illustration. Now, in the table given below, you can see there are 4 years of cash flows, and the certainty coefficient are also given in the question. So the cash flows are 28,000, 32,000, 46,000 and 54,000, and the certainty coefficient is 0.8, 0.6, 0.4 and 0.2. You will see that now for 28,000 the certainty coefficient is 0.8, which means that out of 28,000 you are sure to receive back 0.8%, okay, out of the total amount. Now, the initial cost of investment is rupees 65,000 and the discount rate is 8% annually. Now, we need to find out the whole certainty equivalent method using the NPV, which is the net present value of capital budgeting. Now, that's the question, and now let's go to the solution. So, the first step is always to multiply the cash flows and the certainty coefficient that has been given in the question. So once you multiply, you'll get the certainty equivalent cash flows. So from 28,000, when you multiply 0.8, you're going to get 22,400, and thereby for all the years you would multiply the same way. So you get 22,400, 19,200, 18,400 and 11,600. Now after you get the certainty equivalent cash flows, it is important that you multiply this with the discount rate. Now the discount rate formula is 1 divided by 1 plus r the whole raised to n, where n is the number of years and r is the rate of return. Now in the discount rate given in the question is 8%, which means that it is 1 divided by 1 plus 0.08. Okay, in such a scenario, when you multiply that with the certainty equivalent cash flows, you'll get the present value of the cash flows. That means after 4 years, what is the value of every cash flow that you invested every year? That being, the answer would be 20,740, 16,410, 14,603, 8,529, and the total of this present value is 60,283. Now if you notice in the question, there was an initial investment that was also mentioned in the question. So to find out the net present value, it is the total of this present value minus the initial investment. Now when you minus both these values, the answer for this question is minus rupees 4,716, which is a negative value. So you can see that the net present value is giving you a negative value from the initial investment, which means that the project should not be accepted. So please note that in NPV, when you're using the net present value method, if your final answer is greater than 0, that means it's a positive value, it means the project can be accepted. If it is lesser than 0, that means the project has to be rejected, okay, if it is a negative value. And if it is equal to 0, then it depends on the circumstances whether it can be accepted or rejected. Now same is a scenario even in the internal rate of return, where if the internal rate of return after using that method, which I'm not going to show you in the illustration, if you're using the internal rate of return, if it is lesser than r, which is the rate given in the question, then you have to reject the project. If it is greater than the return, then you need to accept the project, and if it is equal to 0, then you need to accept or reject depending on the circumstances and the situations given in the question. So I would like to conclude and say that the certainty coefficient approach is a very simple and a very neat approach. However, there is no practical way of how you're going to analyze this certainty equivalent, because of which each individual have to estimate their own certainty coefficient in their own way. Okay, so it will very significantly matter because everywhere is going to be different. It can be easily accommodated and differential risk among the cash flows, and certainty equivalent should reflect the shareholders' risk preference rather than that of the management. Now for these reasons, the certainty equivalent method is not very used often in the corporate decision making. So the CE approach, or the certainty equivalent approach, keeps risk and the time value of money separately. They will definitely ensure that they calculate the risk separately and what is the value of the money after a certain period of time separately. This separation gives a theoretical advantage to certainty equivalence, because lumping together the time value of money and the risk premium compounds the risk premium over time. Hope this helps. Thank you.